Hello, everybody. Okay, it looks like the mic is working. All right, well, hello, everyone. And thank you very much for joining us today for our Money Matters event, the first in a cross-Canada series called the Retirement Investing Roadshow. I'm Erica Alini. I'm the personal finance reporter at the Globe and Mail. And before we get started, I would like to acknowledge that the land on which the Globe and Mail is situated is the traditional territory of the Wendat, the Anishinaabe, the Haudenosaunee, the Métis Nation, and the Mississaugas of the Credit First Nation. It's great to see you all here at the Globe and Mail event space, and I would like to extend a warm welcome to all who are viewing the event virtually from across Canada. I'll be moderating the first half of the event, and a little later in the program, my colleague, Rob Carrick, will be taking over. I also hope those in the room with us can stay and enjoy cocktail and some networking at the end. On behalf of the Globe and Mail, I would like to thank Purpose Investments for making today's event possible. We have a great lineup of speakers to talk about the important topic of retirement savings, spending, and income. As we go along, we'll have time for a few questions from the audience. Those in the room, please wait for a microphone to be brought to you. If you're in the virtual audience, please type your questions or comments in the Q&A box. All right, let's get started. So, our first guest speaker is Kelly Keane, personal finance educator and best-selling author of Talk Money to Me. Kelly has worn many hats over her 25-year career in the financial industry, including running a wealth management firm, and she has written 11 books. Welcome to the stage, Kelly.
Oh. Thanks, Erica. Nice to be here. And welcome everyone at home. Nice to see you virtually.
Thanks so much for coming over.
Pleasure.
It's great to have you.
Pleasure.
It's great to meet you in person also.
It is, right? It's so nice. It's
Finally.
so nice. Thank you for coming out.
All right. So we're on a tight schedule, so let's get to it. So Kelly, let's start with the pandemic.
Yeah.
So it has changed and affected so many plans for Canadians. Mm-hmm. What are you observing in terms of how it's changing plans for retirement?
Yeah, we were talking about that at our table with Rob Carrick, and I'm interested too to hear all of the speakers today and what they have to say. What I've been hearing from Canadians across the country is really two camps, right? There's the camp that did really well, right? Some Canadians are sitting on billions of dollars in cash reserves. They weren't spending, they weathered the storm well. And then there's the other camp, which could be part of the family of the first camp, that didn't weather the storm so well. They're still digging themselves out. You know, there were so many surveys about Canadians barely surviving before the pandemic. And then, of course, people either being forced into early retirement, maybe having to look after their parents, a sick parent, and just said, or burnt out. Like so many people in the medical industry just burnt out. And the reality is that I find this number shocking. 1.5 million millennials moved home during the pandemic. So what does that mean to your kids and all of that? And then wrap it in a bow of inflation that certainly I heard from my parents about, but never really experienced. And this has put such a wrench in the retirement planning of so many Canadians.
Yeah, and that's a really good segue, actually. So we've had the first 2 years of the pandemic, and now we're in year 3, which is shaping up to be its own wild ride. Mm-hmm. So we have inflation, like we haven't seen in 30 plus years. We have rising interest rates, declining home values, and financial market turmoil. So what are some of the strategies that current and prospective retirees can use to hedge against all of these risks?
Yeah. One strategy I like to look at, like definitely a lot of personal finance columnists in this audience, and we're often talking about cutting, right? Where can we cut? Where can we cut back? I love having the other conversation of where can we bring in more income. And I think certainly in the financial industry, we do not put enough focus on what I call your fourth asset class, and that's your career, right? Because even if you earned the average income, you're going to earn millions of dollars during your lifetime. And by bringing in even a little bit extra income, and I don't know if we've got that graph or not later on, I'll refer to it. If not, that's okay. But just a little bit of extra income can make such a difference in your retirement. And I don't know about you, but when I started in the industry about 25, 26 years ago, Freedom 55 was all the talk, right? You're going to retire at 55, and it was almost like a Lotto Max commercial. I'm 47. I don't want to retire at 55. And when I talk to my friends that are in neuroscience and all of the advancement in medical technology, they're telling me I could live to 130, and I want to live to 125. Now, y'all maybe don't want to work till you're 125, but I mean, the fact is, if you just can bring in a little bit more, that's a huge hedge against all of these factors that are eroding your income potentially. And I'll give you a couple examples from some readers of mine during the pandemic. One was retired and decided to come back in, and this is a new trend as well that we can talk about, called unretiring, and it's happening more and more. So he's from Vancouver. He was telling me during the pandemic he was just bored, and a lot of his neighbors had dogs that even though they were at home, they didn't want to walk the dogs. And so he started a little dog walking business. Well, over the last 2 years, it has actually been bringing him in $100,000 a year. So much so, he's buying extra vans, he's hiring extra dog walkers. On the subject of dogs, another woman wrote into me from Ottawa. She couldn't get a dog groomer. There was like this 2-month wait to groom her dog. So she bought this like, kind of like an old motor home, had it revamped and everything, got subscriptions from people that had dogs to pay for it even before she bought it, got some other dog groomers. And then very lastly, a woman out of Alberta was telling me English is her second language, and she didn't have any skills. She was a stay-at-home mom, already had a reverse mortgage on her property, and really in some dire straits. And her church introduced her to a couple of seniors where she could just cook for them and kind of provide some company and companionship, and she's bringing in over $2,000 a month. So I think having that conversation of like, where else can you bring in some income is really, really important, even if it's just to enjoy your retirement a little bit more.
That makes a lot of sense. But on that note, and maybe a quick follow-up question. So we often hear, don't think that you have to retire at 65. You can work longer. On the other hand, I've also encountered people who were planning to work maybe into their early 70s or so, and then lo and behold, they kind of were ejected from the industry early on. There are some industries in particular. I can think of maybe the entertainment industry being one, the film industry, where there's a real problem with ageism. I think advertising is another one that has a bit of that reputation. And so on the other hand, you have some people who would very much like to continue working, and they kind of like are out of a job much earlier than they had planned. And I've also heard of sometimes sort of working longer, parlaying that career that you've had into maybe a consulting business, because I think a lot of people would like to keep doing something, but maybe not sort of the 9 to 5 or even the 8 to 8 these days. But it can require, there's some hiccups along the way for some people, depending on the industry you're in. And also sometimes it takes a little bit of preparation, right? So have you heard about that? Like sometimes it takes a little bit of planning ahead to make sure that you do have that option to bring in extra income.
Yeah, and a lot to unpack there. I mean, there is so much ageism right now, but I think baby boomers have certainly changed that conversation, albeit slowly, right? We see Elon Musk's mother modeling, what is she in her 70s? She's gorgeous, and changing the conversation of what's acceptable. Paul McCartney just turned 80 on the weekend, and we're seeing him still play with vigor. So it's changing, albeit slowly, but you're right. Like if it comes to, let's say, wanting to consult in your industry, that you need a little bit more runway, I think, to really also have that, planning process of how you're going to set that up. So what I've been talking about for years is, in your 40s and 50s, and I got this idea from an executive at one of the big banks when I got his autoresponder, and it said, I'll get back to you in a year because I'm on sabbatical. So then I'm like, what? Is that really a thing? And yes, it is a thing. And some employers actually pay for all or a part of it. Or is that something you need to build into your pre-retirement planning? And not a sabbatical just to take a sabbatical, but a sabbatical to retool, to figure out what is going to be that encore career. What are you going to do in later life that either is an extension of what you're already doing or something totally different, right? That you get to explore and you get to play with this hobby to see if you can transition to bring it into a business. Because gone are the days of, I think they have been for a long time, of the golden watch and the loyalty to one company. And I think too, like something that's been devastating as much as the pandemic are a lot of anecdotally friends in my world that are near retirement, had that one job, super secure, and all of a sudden have been forced out. And they've never done a side hustle. They've never had a side gig. They've never thought as a business owner. And it's a real challenge later in life to just all of a sudden get your head around how you're going to navigate those later years and even income aside, right?
Yeah, that makes a lot of sense and totally resonates with the conversations I've been having. So I want to bring it back to inflation, which is top of mind for everybody right now. There's this notion often when you talk about seniors, people who are already retired, that they kind of are, they have a cushion against inflation because a lot of government benefits for seniors are pegged to inflation. But is that really, especially right now when we have inflation that's rising so fast and kind of caught everybody by surprise, are benefit rates really keeping up these days?
Well, and that's the thing, especially if you're on that fixed income. So I'm not sure if you're aware or not, but OAS and GIS are indexed quarterly to inflation. So they will catch up eventually. But if you look back over just about the last 2 years, so from February 2020 to April 2022, it only was indexed about 2/3 of the CPI, of the Consumer Price Index. So, and we know when we hear these numbers, and we'll hear the newest numbers this week, they're going to be out, right? We hear these numbers like 6.8%, and it's only at 2/3 of that. And you go to the grocery store, and StatsCan said last week that groceries are up 9%, gas is up just about 40%. And I think 9% is really, I went to go grab a bag of avocados last week that usually was $6 and it was 14. So I beg to differ that it's only 9%. We're feeling it a lot more. So yeah, that's definitely something that you need to factor in your planning. I mean, the government last year gave a little bit of a bonus for those on OAS, a $500 bonus last August. This July, those 75 and older getting OAS will see a 10% increase. But my goodness, for those on a fixed income, is that enough? And then factor in that CPP and GST and some other benefits are only indexed once a year. There are a lot of calls for those to be indexed quarterly as well.
Okay, yeah, no, for sure. CPP was very much on my mind.
Yeah.
The once a year adjustment. So let's talk about housing a little bit. So, home prices are declining, which is something that a lot of us aren't used to. And you're in Alberta, so I guess Albertans maybe a little bit more than anyone else.
Yeah.
In Canada, but the trouble with housing is not just, I would say, the declines in equity. People have had such enormous gains in the past few years that I wonder whether the bigger impact for what's going on in housing on, near retirees and people in retirement isn't so much the equity bit, but the mortgage payment of the younger generation.
Yeah.
Either helping them with the mortgage payments or helping kids get in the market where we still have very high home prices now coupled with interest rates that are rising very fast.
Yeah.
So what does that mean for mom and dad's retirement?
It means a lot, and Rob Carrick has been writing about this for so long and so often in every nuance. And I think I saw something that if the Baker mom and dad were actually a financial institution in the US anyway, that they would be the 5th largest. I'm sure Canada is probably pretty close. And in Toronto, the average gift of parents to adult children to help them buy a home is $130,000. That's huge. So there's a little bit to unpack here. And then I'm sure a lot of you heard this survey last week from Manulife Bank that 1 in 4 Canadians are saying they can't afford their mortgage if interest rates continue to go up. So how is that going to affect prices declining? And if you're already retired, how does that affect if you want to downscale? If maybe you need to take a reverse mortgage because you're house poor and that's the only way that you can survive living in your home, or you need to sell your home to move into a retirement residence, how is that going to impact it? But when it comes back to the kids, yeah, this is a huge issue. And FP Canada, I think you have someone, Alexandra, speaking from FP Canada today. They did a survey pre-pandemic that 25% of those in the sandwich generation that have parents and kids that they're helping out, 25% of them aren't going to be able to meet their financial goals. And 27% of them are incredibly stressed. So there is a lot of help going out. And then in research for my last book, which came out just recently, I was shocked at the number of cohabitations going on, which actually makes sense, right? A lot of young people saying, look, we don't want to get married, but it makes sense to cohabitate. Here's the problem. If mom and dad have given a large gift as a down payment or something of that sort, and there's no cohabitation agreement, how does that affect that gift later on? How does that affect, bequeaths to your other children and conversations at Easter and Thanksgiving, right? All kinds of things going on here. So it just means a lot more conversation and a lot more planning with your financial planner.
For sure, yeah. And yeah, you're right. You're absolutely, because we're all so awkward about talking about money, right? These big gifts often go out.
Oh, yes.
Without a proper conversation
Yeah.
about, and I'm thinking the conversation often is about how much can you really afford to give, and it's something that should come. Speaking as a millennial, right? And that's something I've written about. It's as if you're on the receiving end, you should also be asking the question, okay, mom and dad, fantastic,
right,
but have you talked to a financial planner to make
Yes.
sure that this is how much have you taken everything into account, all the costs that you may encounter in retirement,
Yeah.
to make sure that this is really how much you can afford to give.
Exactly. And especially if you're borrowing for that gift, or you're taking it out of an RSP or a RRIF, then the tax implications, is it a gift, is it a loan? All of these conversations, if they're not had and they're not documented, can be a lot of pain on a number of levels later on. Yeah.
Absolutely. So generally speaking, so what are some of the big trends or concerns that are on your radar when it comes to retirement?
Yeah, definitely some of the trends right now and concerns would be the stock market. Certainly getting a lot of emails on that. I'm not a portfolio manager, but when I do talk to my portfolio manager friends, I'm hearing them talk a lot about some alternative investments, like investing in mortgages, real estate, maybe even private equity. Now, this is not for the faint of heart. This is not for the low risk. These are for the accredited investors that also have that expertise and can weather that. But if you talk about private equity, for example, I think we're getting a lot more companies getting into that, a lot more, getting down the initial investments. And brilliant billionaire that I interviewed years ago, Michael Lee Chin, Canadian billionaire, he talks about private equity and the illiquidity discount. So 2 companies identical, one on the stock market, one not on the stock market. Because you can't sell that one easily that's not on the stock market, you should expect a higher potential return. But there's a lot of risk in that because you can't sell it, but also a lot of potential reward. So looking at things like that, you'll also see that, Purpose is the sponsor of this. They also have been looking into their investment income for life pension solution. People are now looking at annuities again, right? With interest rates maybe increasing. They have a really interesting solution there too. So definitely looking at what are all of the other options on the market that maybe we haven't been thinking about because interest rates have been so low and it's not even been in the conversation.
And on that note, things that probably people haven't been thinking about in a while, GICs, guaranteed investment certificates. So for a long time, I mean, the interest rate that you could get on a GIC was far, it wasn't much.
Yeah.
Now with interest rate rising, we certainly have seen GIC rates also go up. Same is true of high interest savings accounts, but I've been a little dismayed at the speed with which we've seen these incremental increases. They're still, it's hard to speak in general, but mostly still far below the inflation rate. So what are your thoughts on, is it time to get back into GICs or not so much?
Yeah, I mean, it's really tough because you do want, especially as you're nearing retirement, you want to look at those guaranteed solutions and how much of your portfolio should be comprised. But remembering, after tax, after inflation, regardless of what the inflation rate is, you're always losing money, right? When you look at that sector. So, back when I was at the bank many moons ago, there was and there might still be these equity-linked GICs and things of that sort where, basically you can do it yourself, where you buy a long bond, you guarantee your principal, and then you play with the rest. So, it's just really having these conversations, getting back to the basics as you enter pre-retirement and retirement. Very important conversations that you're not chasing the market, that you're not chasing interest rates. You are designing a portfolio and a plan that works for you, and you're only deviating from that plan when something major has happened. There's been a death, you're retiring earlier than you thought, or working later. It's not because the market is going up or down, but certainly the conversation of, do these asset classes make more sense now as we see interest rates coming up? And then if you can time it where you lock it in when rates are coming down, well, if you've got that crystal ball, I'd love to know. But definitely a different conversation than we've had the last 20, 30 years, for sure.
That's for sure. And so, in another general question, so over your 25-year career, so what are some of the most common pitfalls when it comes to retirement planning and spending that you come across?
Yeah, I would say definitely your pension. If you are lucky enough to have a pension, we were having the conversation at our table that they still exist, especially the defined contribution, where you know what you and your employer are putting in. I find so many people just check out, right? They opted in if they did. They don't really know what they're invested in. They're not looking at it. They're not necessarily reducing their risk as they're moving into retirement, unless they've got target date funds that are doing that for them, lowering their risk. And Rob has also written about this, that there are $3 to $4 billion, it's estimated, that Canadians are leaving on the table each year because they're not taking advantage of their employer matching programs. Like, huge dollars that are being left on the table. Some other pitfalls are definitely not talking to a planner soon enough about, let's say, melting down your RRIF early because you want to, not lose your OAS, or getting money out of your corporation, how to do that the best way. Like, I find that people, especially when I was in the industry, waited a little too long, where it's like it's on their radar imminently, and it's like there's not necessarily enough time. And then, of course, if you're planning later into your retirement, that graph that I mentioned, if we aren't able to put it up, I'll throw it up on Twitter. Sean Todd, a great fee-only financial planner, did it up for me. It's impressive how much longer your income can last. And then very lastly, when I was in the industry, the number one question I would hear from everyone was, you've been out on the field, now you're going back in the bleachers, and it was like, what is everyone else doing? What is everyone else taking? Like, when you would ask them, how much income do you want? Like, it doesn't matter what anyone else is doing. It matters what you want to do, how you want to do it, and then I think it's important to have a professional on your side that you check in with once in a while, or at least tweak that plan because how else are you going to know your blind spots? But if you do want to do a little DIY, this is a mouthful, but the Financial Consumer Agency of Canada, they are wonderful, and they have so many resources and tools and calculators and retirement guides. I really would encourage you to Google that, FCAC, and then just put resources, fantastic stuff. So it's just empowering yourself and you know, a little bit of you might not know what you don't know.
Absolutely, yeah. I love the FCC site.
So good.
I'm there all the time.
Right?
And yeah, and I would probably add another one, the Get Smarter About Money site for the Ontario Securities Commission. Also fantastic resources there.
Yeah, and actually every security commission across Canada has some great resources, but Get Smarter About Money is a fantastic one. Yeah, great friends over at the Ontario Securities Commission.
Awesome. Thank you so much for this great conversation. And I'll throw it to the audience for any questions, either from here or from anyone who's watching remotely.
Yes.
Kelly, can you elaborate on that graph, what it illustrates and what insights it generates?
Yes, thank you. So yes, this graph really just looked at if you were 60 years old, I think Sean Todd had the numbers of $500,000, how long your money would last. And by working just 5 years more, earning $35,000 a year, it really wasn't much. It was like something like $135,000 more were to be had, and your money would last well over past, I think it was age 87. It put a number of more years on how long money would last. So I think that's just a great conversation of, you know, it doesn't have to be the full income that you earned when you were working. If you even just earn a fraction of it, and you sit down with your planner and look at it, and those are the years you want to travel, those are the years you want to golf, and you want to give back, and you still want to be as active as possible, that's when you want as much money as you can. And if that can alleviate your fear of running out of money or having enough to pay for your long-term care, that goes a long way, I think, to your mental health and physical health and quality of life, and not stressing at night. Great question, thanks.
Are you especially recommending that to your clients who maybe have retired since January or expect to retire imminently, because it gives them a bit of extra protection from sequence of returns risk?
So the question was, first of all, I'm a personal finance educator, so for the last 17 years, I don't have clients. I'm on the personal side. I was in the industry, so I don't recommend, but I definitely recommend you talk with your planner. I think it's just an important conversation, because so many people are worried about running out of money, and they just kind of throw their hands up to, well, I hope, you know, government benefits will be indexed. I hope my pension will, our table was like, I hope CPP will be around. I mean, at 47, that is always a conversation that younger Canadians are having. So just planning to have that extra income, and to your point earlier, doing some advanced planning if you can, into what will that look like is as important, I think, as diversifying your portfolio, in my opinion.
We have a question from the virtual audience. They're asking, they're saying reverse mortgage rates are much higher than a line of credit. Please speak to the wisdom of a reverse mortgage.
Maybe you'll touch on that too, but I mean, certainly, I think as long as a product is legitimate, there's no right or wrong product. It's what's right or wrong for you. And a reverse mortgage can be a solution for someone that absolutely needs to stay in their home. They need the flexibility of the cash now. They don't have the income to approve. And they really don't, let's say, have any legacy to worry about. That might be a great solution for that person. But they should still shop around and talk to their bank, because yes, rates are going to be higher than taking out a line of credit with their bank, because theoretically you can do the same thing, right? So also the benefit of the reverse mortgage is you're making no payment until you pass away or you sell. Well, we in this room understand compound interest. So if you're paying a much higher interest rate than you would for a line of credit and you're not making any payments, how does that look? You just want to go in knowing all of the pros and cons, and you can structure it yourself. If you've got a line of credit with the bank, put aside enough to make the payments. But there may be income requirements or things of that sort that might not be possible. I hear from a lot of widows or widowers that just didn't have a credit score. It was hard for them to approve, or they just don't have the bandwidth. Maybe their children need to get them into a retirement facility. It's not right to sell their home right now, and the reverse mortgage is the solution. So you can see where there isn't a right or wrong, a yes or no. You need to do a deep dive into how you're funding, if that's an option that you're looking for. But great question.
Yeah, and I would say, and also lines of credit are callable. Which,
very good point. Yes.
Which rarely happens, but whenever you hear of the terms of the line of credit being modified, tends to be a time like this when interest rates are rising and the economic outlook is looking iffy.
Yes, good point. Yeah, you need to know the downside and upside of both for sure.
Awesome.
Thanks.
Do we have anyone else? Oh, yeah.
Oh, there you go.
Melting down your RRIF. Can you tell us how, why, and when?
Yes. Melting down your RRIF is a strategy. So when you turn 71 and you're forced to take out the minimum payments, for some people, maybe at 75, at 80, what have you, those minimum payments are going to be so large, let's say, in addition to maybe other income, that it's going to cut you off from your OAS, maybe you and or your spouse. So I'm not saying it's for everyone, and again, it's something you talk to your financial advisor or planner about, but maybe in your 60s, you're starting to look at, do you still fund the RSP? Like, how big is that RRIF going to get? Do you start drawing down at an earlier age so then you aren't losing your OAS that you worked so hard with your tax dollars to receive, right? So, as they say, you don't want the tail wagging the dog. You don't want to be running after a tax strategy and doing something over here that isn't right for you. But these are just questions that you should be asking in your late 50s, your early 60s. Where is your money? How is that going to look? Like, does your spouse have a pension? How is that going to kick you into different brackets? But you need some long-term planning for that, right? Like, by the time it's happening, oftentimes it's too late to do anything once you're already in that tax bracket. Thank you. Good question. Time.
All right. Well, we're gonna have to leave it there for now. And but thank you so much. It was such a great
Thank you, everyone. Great. Thank you. Great question. Okay.
All right. What is happening? So our next speaker is Jackie Porter. She will join us today remotely. And sorry, let me get my papers in order here. Okay, so yeah, so next up is Jackie Porter. She's there. I can see you on the screen, Jackie. Welcome. She's joining us remotely. She is a certified financial planner and founder of Team Jackie Porter. She and I have had some great interviews. In addition to serving business owners, Jackie and her team help people set and achieve their financial goals as they near retirement. So thank you so much, Jackie, for being with us today.
Thank you so much, Erica. I was so looking forward to seeing you in person, but it's clearly not to be.
Jackie emailed us this morning saying that she couldn't make it in person, but it's great to see you on the camera. We've only ever spoken over the phone.
That's true. That's true.
So, Jackie, let's start with the big picture. So, many people tend to think of retirement as one block or one big phase. What is your view on that?
I think that the view of retirement is beginning to change. And at this point, people are no longer seeing it as an event. And I think the good news is we've had so many medical breakthroughs over the course of our lifetime. And that's led to people living expecting to live much longer than their parents. Instead of actually having, 20 years in retirement, if you were lucky in the past, the length of retirement is actually becoming a lot longer. And I don't know if many of the people in your audience know this, but the fastest rising population at this time in history are actually centenarians. And according to Stats Canada, that number is actually going to continue to rise, which is shocking, right? So think of it this way. If you retire at age 55 today, you might spend 45 years in retirement, or almost half your life. Just think about, how's your health? How's your emotions? And what's your financial needs going to be over that course of that time? How will they change? Especially when you're planning for a 45-year timeline. One of the things you have to consider is, will you fully stop working if you've got 45 years to go? Can you afford to stop working? What about your health? And if you live longer and your investments need to pay for your lifestyle over this longer horizon, how will you pay for care if you need it? Perhaps you'll need to downsize to pay for care. And I think one of the things people really need to consider is, how might your spending patterns change as you age? Finally, and Kelly touched on this, is how much retirement benefits will you actually have access to from your employer or through government-sponsored plans like CPP or old age security? So these are some of the important questions that you really want to have answers to as you contemplate exactly what your retirement is going to look like. Recognizing you'll experience really many changes when you have a longer lifespan, it's important to think of your retirement from the perspective really of stages, the stages you're going to go through over your lifetime, instead of thinking of it as a permanent vacation, which many in our industry were educated to teach clients to think of their retirement that way.
Yeah, I think you've made some great points there. So there's, on the one hand, the fact that the transition from, it's no longer a transition from work to not work necessarily retirement. For so many people, it's very gradual, right? The shift to not working. And on the other hand, yeah, there are many phases of retirement. So can we talk a little more specifically about the stages of retirement and what they look like?
Yeah, I think this is something that's also often overlooked, and we don't spend a lot of time talking about it. But when I work with clients, I really want them to think of their retirement in 4 phases. Now, phase 1 is when you're actually starting to think about retirement and your actual level of readiness, figuring out whether or not you can afford to retire and, what your retirement's going to look like. So we talked about, working, can we afford to stop working? It's also asking about that gradual move from full-time to part-time. If you're thinking, 45 years is a long time, I'm going to have to fund my retirement. Maybe I won't just stop working. Maybe as we talked about, you'll gradually move to stopping work altogether. So those are some things to ask yourself. Will you go from full-time to part-time and then stop working? One thing I'm seeing a lot more clients in my practice asking about is, what are they going to do with the time? I deal with a lot of type A clients who are used to being very productive. So to go from that to stop working altogether can be anxiety filling for some people. So what are they going to do to fill their time? What kind of hobbies will they have? So that's the first stage, which is pre-retirement. Now let's move on to the actual retirement phases. So the first one, the early years in retirement, and most people will recognize this because Freedom 55, I feel, was built around this concept. It's called the sweet years of retirement, because that tends to be your most active years of retirement, when you tend to be more social and active. In this stage of retirement, your budget is also focused on spending money on those things, spending money on your hobbies and your social activities. So that's stage 1. That's stage 1 of retirement. The second phase of retirement really is about, and so the first stage is between 55 and 75. So now let's go to the second phase of, you're living your best life in stage 1. In stage 2, the second phase is all about, and so stage 2 is from 75 to 85. That's known as the stay-at-home years. And yes, it's what it sounds like. Many of us have been living the stay-at-home years during COVID. So what does that look like? Perhaps you've had a few health challenges at this point, and you may not be as mobile as you were in the past. So you might just want to spend more time with your grandchildren. I'm seeing a lot of my clients sort of balance their time talking to me with babysitting their grandkids. And then the last phase of retirement is known as the unknown years. And in this phase, having cash to cover healthcare costs are paramount. So here are the 4 stages of retirement: the pre-retirement, the sweet years, the stay-at-home years, and the unknown years.
That's super helpful. And when it comes to cost, so I gotta say, the stay-at-home years sound pretty good, but the sort of the honeymoon phase of retirement and the last one sound like they could be pretty expensive. Is there one stage of retirement in particular that tends to be the most costly?
Oh yeah, for sure. That is definitely the sweet years when, as I said, we're living our best retirement life because we're at the peak of our health. We're the most physically active. We want to spend money on our hobbies. So we want to travel if we didn't get to do those things. And so for these reasons, in the sweet years in retirement, you're spending the top of your retirement budget. So whatever you budgeted for retirement, you're going to spend 100% of that in the sweet years. In the stay-at-home years, you're doing more things at home, probably having more meals at home, doing more, exercises or social activities closer to home. So you tend to spend only 75% of your retirement budget. And then in the unknown years, you're only spending 67% of your actual retirement budget. Keep in mind, elderly seniors are not having large meals. They're not doing a lot of fine dining, right? They tend to, eat fairly smaller meals. They tend to be lean and mean in terms of their budget. And really their biggest priority is putting money aside, making sure they have money to pay for those healthcare costs that they just don't know when they're going to come. One thing I want to talk about when we talk about the sweet years versus the unknown versus the stay-at-home years, it's important to think about your chronological versus your biological age when you're planning, because your chronological age is your current age. It's what your age is now. But then there's your biological age, which is how healthy are you based on your health stats when you compare those stats to other people. So some people can be, in their sweet years longer or shorter. Some people can be in those stay-at-home years, again, depending on their chronological age, their biological age. They could be in that, unknown years earlier. So just these are things to really think through and talk through with your advisor, just to really make sure you're planning accordingly.
And thinking about that last phase, so the unknown years. So it sounds like the fun years, or the most fun years, are the most expensive. On the other hand, it seems to me when I think about the unknown years that there's also unknown costs there. Right. So maybe a little harder to plan for. And also coming out of the pandemic, so it's like, as a personal finance reporter, it's my experience that a lot of people forget to plan for the unknown years. And also after the pandemic, there's a lot of concern about long-term care homes and do I want to be in a home or do I want to age in place in my house, which I'm not sure could perhaps be more expensive. So what are some of the conversations you're having around that?
You know what? You're 100% right, Erica. People are horrified coming out of the pandemic, witnessing the challenges with long-term care homes and thinking for themselves, do they really want to receive care in those facilities? And, what will it cost for 24-hour care and, kind of how will they pay for it? And, what alternatives to get care are available and what will they cost? So these questions are actually being tackled right now by the government because they are looking for alternatives to this long-term care home sort of facility scenario. I know baby boomers who are, coming closer to retirement and thinking about what their unknown years might look like, want other alternatives. So really there are models that are being studied right now coming out of Europe. So stay tuned for more options for, what your retirement can look like, what alternatives are available to long-term care homes. The crucial thing for you to know, and Erica touched on this, is it's going to take a big bite out of your retirement budget. So here are some of your options. if you choose to live in a retirement community, you can get some of your daily needs met. You can customize the amount of care you might need as you age. However, you need to know that retirement communities do not offer 24-hour care. They don't. But the thing about costs when it comes to retirement communities, they can really vary. And this is in Ontario in particular, depending on the number of care services offered. So, for example, if you want a private room in Ontario, and depending on the number of care services you take, it can be anywhere from $1,500 a month to $6,000 a month. And again, this isn't covering 24-hour care. This is just saying, you know what, I'm at that stage where I want to be in a retirement community where some of my care needs are going to be met. This cost, by the way, is 100% out of your pocket. So, because it's considered private care. So that's one option. At the same time, if you opt to be a part of a public long-term care facility later in your life, care will be provided. The government will provide that, but you'll still need to pay for accommodations that can add up to another $2,000 a month. So that's another thing to think of. And that's the thing that people are worried about. Yeah, you get what you pay for potentially in a care home, in a public funded facility, especially based on what we know during COVID. Is that an option you really want to take? And now finally, for all of those reasons, people are thinking, I'd love to get care in my home. So for many seniors, home is really where the heart is. So getting access to care in your home is also, of course, becoming more and more popular out of COVID than moving into a retirement community, because it allows you to remain independent for as long as you possibly can. However, it's important for you to know the cost for home care can really, really add up as well. So even though you may be able to get some of your care needs funded through the government, or through maybe you've got benefits through your healthcare plan, expect that you're also going to have to come up with money over and above what the subsidy you get from the government will give you. So I want you to get a sense of what these costs might look like. So for example, a personal support worker can be anywhere from $25 to $35 per hour. If you're looking at nursing care, you might be looking at $75 to $100 per hour. So I think cost for care is something that every senior needs to be thinking about, because you're right, Erica. Yes, the sweet years, which is again what we tend to focus on in this industry, that isn't when you're at the top of your retirement budget, but you can easily spend a lot in those unknown years on healthcare costs. And so it's really important for you to balance that out. So just multiply $25 to $35 per hour or $75 to $100 per hour by the number of hours you'd need for care not covered by the government. So I think cost for care is something that every senior needs to be thinking about. This is especially important because we're going to face a tsunami of seniors aging at the same time. So costs might continue to rise at a rate faster than we might think. You might also see less subsidies provided by the government as more people try to access these services. So if you're determined to live in your home after the horror stories of COVID, have you fully factored in the cost of care into your retirement? Or alternatively, have you thought who would care for you and what that might look like? Many people don't want to be a burden to their family, but at the same time, they haven't fully thought through what care would look like if they needed it.
Absolutely. Some great points there, Jackie. Thank you so much. And I want to touch very briefly before we throw it to the audience. Talking about, again, going back to phase one or phase two, sort of the pre-retirement phase and that first retirement phase. So we're used to something that we all grew up with is also the notion that, by the time you're very close to retirement or in retirement, for sure, your mortgage is going to be paid off. And we heard about reverse mortgages, but I also want to talk about regular mortgages, because more and more people are still paying off their mortgage in their 60s. And now we have interest rates rising. So have you had those conversations with your clients, and what are some strategies around that issue?
I think if you're someone who right now is retiring with a mortgage, you should have a plan that factors in a higher interest rate on your mortgage than you're currently paying, because the truth is interest on your mortgage, the cost of interest going up, in your retirement plan will really affect what you'll have left over for lifestyle costs as time goes on. So now is a really good time to meet with your advisor and look through, I'm going to have to continue to carry a mortgage in my retirement. I'm going to have to pay interest. Let's factor in those interest costs because they can really take a bite out of your retirement budget. When I do financial plans and my team does financial plans, we often look at strategies to pay down the mortgage sooner and really just review the budget to see where spending can be reallocated to pay down debt, because I often find that this is something that my clients are worried about. So one strategy I've used a lot is shortening the amortization so the mortgage is paid over a shorter period of time. And this is something you kind of have to do the math on to see, which scenario might align best with your budget. So sometimes if a client has a 15-year mortgage, we'll look at shortening the amortization to 10 to see how it affects their overall cash flow. Or if you're currently in a 17-year mortgage, maybe we'll look at dropping it to 15. Anything we can do to help our clients pay down their mortgage sooner. It also may be a good time because there's a lot of people out there on variable, they might be coming off a fixed and trying to decide what they should do. I don't have the answer on that, but I think it's a good time to discuss with your broker the pros and cons of fixed versus variable. We've been in a low interest time for quite a few years, and I think people may have been naive to think it was always going to be this way. I just know that for a senior that's living on more of a fixed income, the more they can predict what their mortgage costs will be, the better.
For sure, and that makes a lot of sense. We'll leave it here, and let's hear if the audience has any questions, either in the room or from home.
If anyone in the room has a question, go ahead. Otherwise, I can provide a virtual audience question. Anyone in the room? No? Okay. So we have someone from the virtual audience asking, I'm 63, single with no dependents and no particular need to take CPP. I was planning to wait until I'm turned 70, but the combination of inflation and troubling financial forecasts have me considering taking it now. It would mitigate the inflation hit, especially on gas and groceries, and that's just today. What are your thoughts?
As a rule, FP Canada, like most of guidelines that we're getting from FP Canada these days, you mentioned that you're a single woman, single female, is that we're encouraging our clients to take their CPP later if they can, just because women do live longer. So the odds that maybe you'll have that gap in your plan where you'd have to meet with your financial planner to determine what the strategy is, where to take money from in those years prior to collecting your CPP. But then you're going to have this additional cash in at age 70 because you waited for your CPP payments. So that's going to mean you're going to have a much larger CPP benefit over a longer period of time. So that's going to last you that much longer because you took CPP late. So it's difficult to say with the specifics of your circumstances, what would be the right strategy. I would highly encourage you to talk to a planner for more specific information. As a guideline, though, we do typically recommend that you take your CPP later because you do get that enhanced CPP benefit.
Oh, we have a question in the room.
Okay. Is there some kind of formula to figure out how much money you'll need in retirement? Like right now, we're on the cusp, and I've been tracking what we spend every month, and I'm trying to figure out what would I say to our financial planner, like, send us over $10,000 every month, or send us over $7,000. I was just wondering if there's something.
Yeah, I think the blueprint of any financial plan should be looking at your lifestyle costs. Like, what is it costing you to live right now? And what is it going to cost you in retirement? Like, if you look at what your spending patterns are, you might recall that I talked about spending patterns right from the beginning. And how will they change? So what do you need now to live? What will you need in retirement? Are you spending a certain amount on vacations now, but you're going to spend more in retirement because you'll have more time? What's the number that you're spending now, and what will you spend in retirement on things like vacations? What will you have for things like healthcare costs? Like, do you have a healthcare plan, or is that coming out of pocket? If we factor in what healthcare costs are going to be in the future based on, whether or not you have a plan and what other additional expenses, you're paying for out of pocket for healthcare, what can we project your healthcare costs are going to be? So I think it's a good idea to work with a planner, look at your actual cash flow from a standpoint of what do I need to live? And then you can devise a plan, using things like, well, what will inflation be? Because you're talking about that formula. So what will inflation be? What should I use as a reasonable interest rate? I know these days with the markets being all over the place, the best thing to do is to use a very conservative number. Typically in financial plans and retirement, I'm using 3, 4, and 5% so people can get a sense of what the worst case scenarios look like. The more you can make a plan bulletproof by making it conservative, I think people have way more peace of mind when they draft a plan like that. So a formula is start with the cash flow, start with the expenses, your lifestyle costs first, and then you can go from there. And then really the key is having that number so that you can look at how your expenses are going to change over time. When will you need, what are you going to need for your sweet years of retirement when you might be spending the top of your retirement budget? What's going to be your expenses in your stay at home? Or so a financial planner can work through those numbers with you once they have an idea of, what that lifestyle costs look like and based on what's important to you.
Oh, we have one more question in the room.
In today's circumstances with extremely high inflation and we're in a bear market, do you hold in terms of what you advise your clients to the 4% withdrawal rule to not run out of money by the time you're 90 or 95, or have you modified that?
So are you talking about the four out of your RSP, out of your RRIF?
Your retirement assets, yes.
Yeah, so I mean the 4% rule is a rule, right? So you kind of have to look at how it fits into your specific situation. So is the 4% rule, it might be applicable for some people, but honestly, there's a really great book by Moesh Malevsky. I would highly recommend you check it out. He talks about, in circumstances where the 4% rule may not make sense, as you said, because of the fact that the markets have been unstable, how do we deal with that? I think it's important to kind of look at the specifics of your circumstances. I can't recommend enough if you're looking at your retirement and you're trying to determine what's my withdrawal strategy going to be, working with an advisor to look at where should I pull my money from first? Because when you're talking about the 4% rule, are you factoring in taxes? So for example, your RSP, your RRIF and your locked-in pension plans are going to be much less tax efficient than say your tax-free savings account. So where should we take money from? How are things structured? Do you have things like a spousal RSP that you can help, reduce the income taxes with your spouse and share the tax bill? I think the more you can look at your like a withdrawal rule where it helps your cash flow become more because you're looking at ways to make your withdrawals more tax efficient and put more money in your pocket, that's going to mean that at the end of the day, your capital is going to last longer. The less tax you can pay as you withdraw, the more you can keep your capital. So I think this is a great time to meet with your advisor and do a bunch of different scenarios. Do the 4% scenario. Get them to look at what scenario makes the most sense for you. When we do financial plans, we look at, should we take money in withdrawal? Should we take money in retirement from the corporation? Should we take it from the RRIF? Whose RRIF should we take it from? Typically, we're trying to take it from the lower income spouses plan. Should we start taking your RSPs early, not wait until you get to retirement? That strategy that Kelly was talking about before, the RSP meltdown, all of these things factor into you having your capital last longer.
All right, we're going to have to leave it there. Thank you so much, Jackie, for a great conversation. And we will now take a 20-minute break, and please 2:50 p.m. Eastern for the second half of the event, hosted by my colleague, Rob Carrick.
I'm Rob Carrick, personal finance columnist with the Globe and Mail, and I'm pleased to be moderating the next two discussions. Next up, we have a panel focused on income endurance, or how you can make your savings last through retirement. There have been some interesting developments on that front, and we have a great group of experts to tackle that topic. Let me introduce them. Off the top, there is Sam Seif, founder and CEO of Purpose Investments. Next, we have Jason Pereira, partner with Woodgate Financial, Inc. We also have Alexandra McQueen, Director of Content Development with FP Canada. And just so you know, FP Canada oversees the Certified Financial Planner designation, which is a very respected designation in financial planning. And if you're looking for a planner, look for the CFP. And last but not least, joining us virtually from Surrey, BC, we have Julia Chung, Partner, CEO, and Senior Financial Planner with Spring Planning. Thanks for joining us, everyone. And I think we should just jump right in. I'm going to start off talking about something called decumulation. It's a bit of a jargon word in the financial sector. Everybody throws it around. It's the opposite of accumulation, which you do when you're building up your retirement savings. I'm going to ask Alexandra to give us a quick briefing on what decumulation means.
Well, you've just defined it, Rob. But what I want to point out is that retirement is a life stage. So retirement, if you look in the dictionary and you look at how Stats Canada defines retirement, for example, it's withdrawing from the world of paid work. But decumulation is drawing down from assets. So you can retire without decumulating. So anybody who's got a DB pension that pays all the income that they need in retirement may never need to decumulate their assets. Somebody who has sufficient wealth may just live off interest and income from investments and may never actually withdraw. So decumulation is a subset of retirement planning, and it is different from retirement. Retirement is a life stage. Decumulation is the decumulation of assets.
The accumulation sounds pretty important. It's basically the key to making your retirement savings last. And yet, a common talking point in the financial industry is that no one's talking about decumulation. It's so important. Jason, what's your sense of why the financial industry, including both advisors and the company making the products, have largely ignored decumulation? And also, can you just give us a quick overview of what's on the product shelf in that regard?
Sure. So starting with a quick overview, there's not a lot, right? We have traditional investments, whether they be ETFs, mutual funds, or just buying stocks and bonds. Then you have a couple of products that have longevity guarantees. So guaranteed to some degree or some sort of component where your payout depends on the people in a group living beyond a certain point. So the extreme of that is an annuity. You turn money over to an insurance company, they guarantee you an income for life. It's like buying a pension. Then you have, and so I'm sitting on my right, this Purpose Longevity Fund that they've come up with, the first tontine in Canada. And basically what it is, it's a group of people who share the risk. Now there's no guarantee there, but as people die off from the pool, everybody else benefits from their returns. So it's kind of everybody sharing that risk together. There was a product on the market for a little while called the Guaranteed Minimum Withdrawal Fund, which was a mutual fund-like product that guaranteed a minimum payout for life. Those have largely gone the way of the dodo due to some concerns. Anyway, now why is this not a big deal? Well, why is this not a big conversation point? First off, when it comes to advisors, this is a completely new area and complicated one of education, in that we are very good at telling people how to get from point A to point B, but the problem is that when it comes to decumulation, first off, we don't know what the destination is. We don't know how long this has to last, and you can't just use life expectancy. That's 50% of the probability of you dying. What happens is that we have that, plus we have a lot of uncertainty. Everything's a variable. Cost of healthcare, cost of inflation, whatever it is. And it's not like these people later on in life can go back to work, right? Not many 90-year-olds go back to work when they start running short of money for a very good reason. Now, as for the industry, so to go back to the advisors, there's an entire branch of education that has to happen around this that really has not been at the forefront of advisor education to date. Then you have the other two problems on product. One is tax policy. In the US, they have these products called variable annuities that have some great tax deferral benefits. We don't have that, and it's not possible in Canada under the current tax code. And then the last piece is frankly, we have an insurance industry that likes to act more like an asset manager than insurance companies. There's not a lot of competition in this country. They're not competing for new innovative products. And the perfect example of that is the advanced life deferred annuity. This is something that exists in the budget that we can now move forward with. And I haven't heard high nor hair of an insurance company ever launching one of these. And it's basically a product where you can put part of your RRIF into it, and if you get past 85, then it kicks in with a guaranteed income, kind of deals with the tail end risk. So, hey, it's been announced for over 2 years. I've yet to see one.
Julia, do we have you? We have you on the line. I can see you there. Thanks for joining us. Julia, can you give us a rundown on what I consider to be the foundational retirement income pillars in Canada and how solid you consider them? And I'm thinking of Canada Pension Plan, OAS, Old Age Security, and company pensions for those fortunate enough to have them.
Yeah, thanks, Rob, and nice to see everybody. I think, from Canada's perspective, we actually have kind of three major pillars when it comes to retirement planning. And that first pillar is government pensions. And then we have employee pensions and then personal retirement savings. And when it comes to that first pillar, the government pensions, there's two major pensions that most Canadians are eligible for. The first one is the Canada Pension Plan. And that one is the one that you contribute to while you're working off of your regular paychecks. And then you have old age security. Canada Pension Plan as a contributory pension really is based on your contributions, your employer's contributions, and the management of those funds over time. Those funds are managed, I think, particularly well for a national pension. It's one of the better national pensions in the world, and it is one that we can feel very good about counting on for the long term. I know there was a lot of real concern about the longevity of the Canada Pension Plan maybe 10, 20, 30 years ago, but according to actuarial reports, it is doing tremendously well, and I think we can feel really good about relying on it for the future. The other regular old age security pension plan that a lot of people rely upon, that one, it comes out of just general tax revenues for the government. So it's not one that you contribute to. And this one you become eligible for at age 65. And when people talk about income clawbacks, this is the one where you might actually have some of that income clawed back. So it's important to know the distinction between the two. Canada Pension Plan being contributory and managed separately from general tax revenues, and old age security coming from general tax revenues. And then there's some other pensions as well that might be available if you're particularly low income senior, like the GIS. And then when it comes to employee pensions, those defined benefit pension plans that Alexandra mentioned, these are less and less common because they come with a lot of responsibility on the side of the employer to make sure it lasts for a very long time. And there's a lot of rules. You'll see these most often with government jobs. So if you work for the federal government, the provincial government, you work for a teachers federation, or you work in healthcare, you're going to often find that you have one of these guaranteed lifetime pensions. Alternatively, a lot of employers have what they call a defined contribution pension plan. So basically, the amount that you contribute is defined, but the amount that you received might not be. And then the final pillar is, of course, our own personal savings and investments. And that tends to be what we're talking about the most when it comes to decumulation.
Thanks, Julia. Sam, your company has launched a decumulation product, the Longevity Pension Fund, and we're going to dig into it shortly. But I wonder if you could start by telling us about the demographics driving your decision to offer this product.
Yeah, no, and thanks for having me. And look, I think everything that has been said so far is really important. But really the most important principle is actually what the challenge we have today. So, accumulation is actually quite an easy thing, and it's why everyone does it. It's because why every financial advisor, why every bank, why everyone does it is because one, it's really nice to go out and say, just save, 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 save. And you've been told that throughout your whole life is, earn an income, pay your expenses, and leave something behind and save. And it's easy. It's actually relatively, whether you buy, investment funds, whether you put it in cash, whether pay down your mortgage, that's all saving, that's accumulating. Whether you go buy, some collectible, it's all savings. The problem why this is such a big issue is because it's hard to do the accumulation. Jason talked a bit of it, which is that there are factors around, how long do people live? When you as an individual think about what am I saving, how long am I, need this money for, you have to transition to this period of I have an uncertain date. It could be 3 years, it could be 50 years. And the reality is all we do know is that people are living slightly longer every year. But the bigger issue is that this has also become a real social challenge that we face today, because today, all the baby boomers are retiring, and they're moving from pre-work, we're earning an income and saving and all the rest of it, to this period of retirement. And so from a Canadian perspective, and this isn't just a Canadian problem, it's globally, most developed countries have this challenge, but in Canada, a large part of our population. Every day, 1,000 Canadians turn 65, and every year, 500,000 Canadians turn 65. And so, it's a big issue. And over the next 10 years, that means 5 million Canadians will turn 65 and be in retirement. And we have no real solution. And one of the things that I struggled with was that in about a decade ago, I've been innovating in the financial services space for a long time. I've been focused on how do we help solve real problems. And about a decade ago, I kept saying, this is going to be a problem that the insurers will solve. The insurance companies will all solve this, and they're going to be the ones who make this, and it's really important that they do their job. And then I realized that coming out of the financial crisis, then the insurers were just bogged down with all their other problems. They were bogged down. Manulife was trying to figure out how, they were not going to go bankrupt, and all these other things that were happening, and they weren't going to solve it. And so, we have a problem with the fact that, and I say, by the way, it's not a problem, it's an awesome thing that people get to retire. It's supposed to be an amazing thing. But we have an issue that more and more people are retiring. We have a system that isn't structured. We have fewer people covered by DB pension plans. That's been going on for 35, 40 years. That if you were lucky to work for a company and get a defined benefit pension plan and get that income for life, awesome. But majority of Canadians don't have that. And so this was a real challenge. And so that's why we needed to solve it.
Can you give us a quick overview of how the Longevity Pension Fund works and what you've learned about it in the year it's been available? I just want to tell everybody we're not running an infomercial here. I'm going to ask Jason for his unbiased opinion on it. But when the Longevity Pension Fund came out, it was a newsworthy event. I wrote a column on it. There was keen interest on the Globe and Mail website. We track these things. People were digging into it. How does it work? What have you learned?
Yeah, it's been amazing, and what a year to test these things, right? It's great. So we launched this, just to give everyone some context. It's the first mutual fund in the world to have longevity risk pooling together. What does that mean? Is that we bring a community of people that are all trying to solve for the same thing. How do I get income for life, for as long as my life will live, and underwrite that together? And so it takes the same principles of what a defined benefit pension plan does for everyone. So Canada Pension Plan, all these other defined benefit pension plans. It also does the same thing that what an insurance company does with an annuity when they do it for you individually. And it brings it together into a mutual fund that's accessible for everyone. So anybody who's 65 and older can ultimately now get an income stream for as long as they live. This is a really powerful principle, and it works with the mechanisms of pooling. So I think somebody made the comment that, as an individual, I don't know if I'm going to live, 10 years, 20 years, 30 years. There's an average. They tell you how long you're average going to live. But as an individual, it's hard because averages don't work for individuals. But when you bring a pool together, actually averages work quite well. And so that's the whole principle of it, is that you effectively put everyone's risks together, and you share in the long-term risk of creating that income stream. So we launched this a year ago, June 1st of 2021. Really something that we had worked for a better part of 4 years to develop, worked with the regulators, worked with the industry participants, and we were really proud to bring it to marketplace. And we've been really proud with the response. We've seen strong institutional interest from parties like Defined Contribution and companies that have pension plans to work with us. And then we've had a lot of Canadians coast to coast working with it already. And it's been amazing to see that we're solving a really important problem. And what I'm proud about is the fact that, I think this is one solution in the planning of a long-term set of things that we have to solve for. Not this isn't the only solution. There's other things we have to solve for, but this is a really important one.
So what you've done is you've created a retail product pension plan.
We've made it a pension plan so anybody can now have access to a pension plan.
Okay.
That's exactly what we've done.
Jason, what is your take on the longevity fund for people who are looking for a way to pivot from retirement savings to generating retirement income that will last as long as they live?
Yeah, so it's not a product endorsement, but it's the only product on the market that is a tontine, so therefore it's a product endorsement. But
just to interrupt you, tontine, what is that?
Tontine, yeah. So tontine, this is a term. It is a pooling arrangement. It's a bunch of people come together, they pool the risk, and the survivors benefit from that. And basically everybody comes in hoping that they're going to be the survivors. But this is essentially the concept. And this is not a new concept. This is an old concept. Moshe Milevsky has been mentioned previously already, and a former professor of mine, and this is one of the reasons why I was able to do some of this analysis, basically wrote a book on this called King William's Tontine. It talks about the history of the very first ones and how they came into use. And they've been gone for a little bit over 100 years. So kudos to Sam for bringing back this old idea, because now is the time for it. So basically, when I looked at this and I saw the release, it came as a surprise because I knew of this product, but I hadn't seen it yet. And I dove right into the materials. I also spent a large amount of time online on social media and in various advisor forums dispelling myths about it, because there's always kind of people looking at these things sideways saying, wait a minute, you're going to guarantee me this and all this, and complete misunderstanding of it. There are no guarantees. Right? There is a projection as to what will happen based on some very conservative assumptions, and I will give you credit for that in the design. Conservative rates of return, conservative assumptions on longevity, meaning that they assumed there's different tables for actuaries. They took the most conservative one, meaning that people live the longest, and a lot of conservative distribution assumptions. So overall, the bar was set very low in order to allow for success, but low at a point in terms of their marketing, but low at a point that was still appealing. So overall, I've done these calculations, and I found that, frankly, looking at all this, and I hope to publish on this at some point. I told you I'm like a year late on this, but the point is that overall, I think that the projected distributions that they've promised, that they've marketed, are probably overly conservative and will likely benefit people going forward to a larger degree. Of course, you have to be in the survivor pool.
Thanks, Jason. Alexandra, let's say I'm trying to assemble a diversified portfolio of retirement income products that protect me from running out of money. What are your thoughts on what to add, and in rough terms, how much of each?
So that's great, because it's a financial planning question. So everybody's needs, everybody's goals are different. We've mentioned the Canada Pension Plan and the Old Age Security. Those will give you a base of income. But many people would find it challenging to live only on the income from OAS and CPP. So the question is, where does the rest come from? So I think one approach is what they call a floor approach, and somebody was talking about how they're tracking their spending, which is the absolute basics of personal finance, right? So if you know how much you need, I need $5,000 a month, I need $10,000 a month, then you can say, okay, I'm going to get this much from CPP and OAS, and what level of guarantee do I want to have on the rest of the money, the floor, the basics that I need. I need to buy pay my vet bills, and buy my cat food, and buy flowers for my kids. Well, all the things that you think make a good and successful retirement. Do you want to have that amount guaranteed? So if so, you can add some guaranteed products. So purpose longevity is a guaranteed product. An annuity would be another guaranteed product, a defined benefit pension. Guaranteed in the sense that that money comes in every month. It doesn't fluctuate with the market. You don't need to worry about it not coming in. If it's a DB pension, it's though you have your work paycheck that just transitions to a retirement paycheck. That's the money you want coming in every month. If you want a guarantee, then maybe look for guaranteed products for that floor of income. And then for the rest, you can put it in whatever you want. Do you want to have stocks and bonds? Do you want to be conservative? Do you have a motivation to leave a financial legacy, in which case maybe you're going to invest to have it grow over the longer term? So those are my general thoughts. You asked for a percentage. I don't have a percentage. I'm going to give you this approach of build up from what you need.
What I took away as a key concept for what you said is it's a mix. Mm-hmm. And like people, I've been writing about like retirement and guaranteed retirement products for a long time. Annuities have never been popular. You should be taking a look at them now. Interest rates are way up and annuity returns are way up. But people have this idea that it's an all or nothing thing. And I think the point you've made is that it's a diversification. I will keep some of my own money that I will have say over it, but I will assign some to a product that will give me a guarantee for some of my money. People love the idea of defined benefit pension plans at work, but if you could buy your own for retirement, they're very leery of them. And I guess one of the things I'd like you to take away is an open mind about that component of your portfolio that would be guaranteed, whatever the product might be.
And Rob, if I could just add to that. Sorry, I was going to say, this is actually really an important point, because as you go, I said earlier that accumulation is easy. Well, accumulation is, you talk about diversification in the words of diversifying your asset base. Like, you've got a bunch of different assets to build a nice diversified portfolio, and you accumulate that way. When you get into decumulation or into retirement, you want to diversify your sources of solving the problem that you're trying to, and your hierarchy of problems. And so this is what we're talking about here, is you've got the knowledge that if you are lucky to be a part of the CPP program and the OAS programs, you got those, but they don't solve most people's basic income needs. But then it's about foundational principles of things that you need, as opposed to just buying a balanced portfolio and saying it's going to solve all my income needs and my growth needs and my decumulation and all these things. And so your actual moment of planning changes quite dramatically at the decumulation or the retirement age versus everything pre-retirement when you're still in savings mode.
Julia, I want to get you to address an aspect of all of this that is might seem off on a tangent, but I think it's super important. We all have to accept that income endurance cannot be ensured by just picking the right products. What can you tell us as a financial planner about the importance of managing your spending as well when you want your money to last indefinitely until you die?
I think that's a really key part of financial planning that I think might actually be the hardest part for a lot of people, is really determining what is my lifestyle cost. And Alexandra was referring to that, about how different it is that how you, for each individual person, how you would put together your mosaic of financial planning products in order to solve your problems. And it's different for each person because each one of us lives a very different lifestyle. So we need to get a handle on that. And this is actually really, really hard to do. It's difficult because, of course, month to month, season to season, you're spending kind of differently. And a lot of people feel very frustrated and stressed out about tracking spending or even forward thinking about spending. And that's really what we want to do when we're doing financial planning, not just looking backwards, but also looking forward. How do I want to live my life? And what do I estimate that's going to cost? And then going backward and saying, did I get it right? Is that really true? What's changed? What do I need to understand about that? And especially in times like these where we're experiencing inflation, that's daunting for everybody, but particularly people who are on, have a fixed pool of assets from which to draw their income from. So when it comes to managing spending, it's really less about, feeling bad that you bought that coffee, which I think is a big problem in the world of financial planning media, and just more about understanding, what is it that I'm spending? What do I think I'm going to spend next year? And where is that going to come from? And thinking about that in those kind of layers of foundational income that Alexandra and Sam were referring to, right? How much is government pension? How much is DB pension? Do I have other guaranteed incomes? And then where's the rest of it going to come from? And what are all the tax implications of those? And how do I plan for that? One of the ways that I really enjoy planning for this sort of thing in the short term, and I know everybody on stage here has talked about this as well in previous conversations, is a concept called the cash wedge. And it's this idea that we have enough money in those retirement savings accounts to manage for the income we think we're going to need in cash or something cash-like, guaranteed. It's not really going to make you a lot of money, but it's not going to go anywhere if equity markets go crazy. And if you have a year or 2 years worth of those withdrawals in something safe, I find it's really easy to weather the storms of markets and inflationary changes. But it really lends itself to the idea that I think a lot of people aren't aware of, is that financial planning is not a one-time event. It is something that you must do consistently over time. You might have your big picture financial plan that you work from, but on an annual basis, on the very least, you should be planning your income to take into account all of these different changes and managing your cash flow.
Julia just said something what I consider to be hyper important, the cash wedge. And I say that because as soon as the stock market started turning down a little while ago, I started getting emails from people saying, I'm worried about my RRIF and having to cash in equity funds or stocks to meet my manual minimum withdrawal. And the way to get ahead of that problem is to have a cash wedge. Tough times seem to be at hand. It's a possibility. Negative market returns. Don't even worry about that. Draw from your cash. Savings rates and GIC rates are very favorable right now. Build yourself a little 1, 2, 3 year ladder. Consider having the money for a tough year or two squared away. You'll never have to sell anything you don't want to sell. Now, Sam, one of the reactions to the Purpose Longevity Fund that I heard was initially, I'm a great investor. Why would I give any of my money to someone else to manage? But we've seen a lot of curveballs thrown since the launch. What are you doing in the fund that individual investors might not have the knowledge or the wherewithal to do?
Well, first and foremost, whether you're an individual investor or you're with an advisor who says, oh, I can just manage this and all the rest of it, it's not about that. It's actually what Alexander said, like, you know, you have income needs. Whether the markets are up or down, you need to draw an income every single year off of your portfolio. And what I call, and what I'd say your basic income is, you know, food, shelter, health, and transport. Those things are non-negotiable. Like you know, you can defer that trip. You know, you can defer some charitable payments. You can defer some of the, you know, the gifts and things like that. You can't defer the basic income needs. And so, you know, no matter how good of a portfolio manager you are, there's going to be difficult moments. We're in one right now. Just so everyone knows, the average 60-40 portfolio, which is what everyone says you should buy as a basic portfolio, you know what it's down year to date? 17.5%. It's one of the worst performing years in history for the 60-40 portfolio. Why? Because bonds and equities are both down. So no matter how good of an investor you are, you could buy the cheapest Vanguard balanced fund and you would be down 17+% this year. And so you don't want to be drawing income in this year from you don't want to be selling those assets, because those are the things that destroy the wealth when you're selling when things are down. So having a structured retirement plan, which is, you know, make sure my basic income, the income that I need to support my basic income needs at any point are coming to me no matter what, is what you do. So what we've done in our portfolio, because of that, we have a very low requirement return. Because of the way the structure works of longevity risk pooling, we pay 6.15% per annum for the 65-year-old, and then it goes up as someone is at different age cohorts as they get older, up to the age of 80. We mean that we can only buy it up to the age of 80. After that, no one new can buy it. And so we pay 6.15. To make that, we need to make about a return in the portfolio of about 4% long term, because the way longevity risk pooling works. Very interesting. So we don't actually manage it very risky. We manage it very conservatively to meet that need. And so, for example, our portfolio return has been about 3.5% down in the last year versus that market. And why? Because we manage a lot of risk management, and that gives us a huge amount of value. Our yield will be up next year or flat for sure, whereas other people would actually have to take a big cut.
Sorry, but just to add to that, there's something that is missing, that question or that statement is missing the point of.
Yes.
And that's longevity credits.
Yes.
Or mortality credits. So just to go back and just describe it. The way it works is when you're in that product, you're guaranteed to receive at least back your principal over time or when you die, but the return gets kept by the group, and they benefit from that. That is something known as a mortality credit. You're benefiting from those people who've passed. You only achieve that in annuities or in this product. So to say, I'm a good investor is missing the point. There's another dimension of investment, of return here from your longevity that you're not getting in any other product on the market except for those two.
I was going to make the same point. You can't pool risk by yourself.
Yeah.
Self-insurance is a misnomer. All you're doing is accepting risk.
Well, and that's the benefit of a DB pension plan, is that they've taken the effort to pool all the employees in their program. So if you worked for a municipality or you worked for a corporation that offered a DB pension plan, they took the thousands of people that work there and pooled them together. That's how they underwrite a DB pension plan. And then they make sure that you've saved into that pool. Every year they put a little bit of your employment income into it. And then at the end, when you retire, they give you an income stream, and then when you pass away, it ends. And that all that value goes to the rest of the people who remain and all the people who are still in the pool. That's how pension plans work. And all we've done is basically taken that and put it into a vehicle that anyone else can pay into, at retirement, as opposed to having to do it over the life of their employment. So it's trying to really take the mechanisms of how a pension plan works and say, this is how you create income streams for life. But I think that it also gives, Alexandra said a really important point. Your basic income needs you manage that way, but then you have all this other money you can manage. You can still manage, and if the markets are up, then fantastic. If the markets are down, you don't have to draw on it. You don't have to take that vacation, or you don't have to draw on for the discretionary spending, but you really bucket your retirement planning because of it, and you can still be a great portfolio manager if you want to be a portfolio manager.
Maybe the great portfolio manager is the one who actually includes, right? The guaranteed
that they
income.
need mortality credits, but
All right. Now, I want to leave a couple minutes for questions, but I would like to have each of you offer a super quick soundbite for everybody. Some thoughts for retirees who are managing decumulation through this intense period of inflation, rising rates, volatile stock markets. Alexandra, what could you give them as a takeaway to based on your experience? When
the group of us met on Friday to go over the questions, what were each of us going to speak about? And Julia and I were talking, and what I said was that often people think if I just had a lot of money, I'd feel really great about my retirement if I had enough. But I'm here to tell you that if you have a plan, that can also give you that sense of well-being and satisfaction. You know what you're doing, you're confident that you can weather storms as they come. So I'm a huge proponent of, if there's one soundbite, it's go out, find a financial planner, an accredited, certified financial planner, and get a financial plan.
Jason.
Where do you think I'm going with this? Exact same location, sorry to say. I mean, as a financial planner and as the president of the Financial Planning Association of Canada, I will say this much, and even from personal experience. Especially in decumulation, more than any other point in life, you deal with this uneasy sense of uncertainty because you don't want to run out of money and I've seen it with people in their 90s, it is heartbreaking. You do not want to be those people. But frankly, more often than not, that anxiety is also coming from a place of, I'm not going to say ignorance, but lack of information, where you are fearing the unknown. Solid financial planning and coaching, and Julia said earlier, it's not one thing you do once, it's an ongoing thing. I like to say, it's not a noun, it's a verb. Financial planning is a verb, it's a continuous process. And engaging with one who can basically not only tell you that, yes, you're in good shape for retirement, and also tell you what the downside looks like, but can also help you shift gears and make changes along the way when that happens. Because maybe you don't have enough to have the exact retirement you like unless everything works out the way it's supposed to. But what does the downside look like? Maybe it's a change of like $100 a month. It may not be substantial, but you can't answer these questions in an uninformed position unless you get quality advice around your life.
Julie, I'm going to throw it over to you, and I hope you're not going to say financial planning is super important.
She's my vice
got
president.
That message.
Yeah, well, to give you a different message, because obviously we've definitely said a lot of things about financial planning, but a slightly different one to think about when you're in this period of inflation and rising rates and volatile stock markets. Things are really scary, and these things that are really scary, and that's reasonable to be scared about them, those things are happening in a place that you have no control over. This is all external stuff. And so what should we do when we're dealing with things that create great anxiety in general? We should focus on the things that we can control. So what is my spending like? The inflation looks like this. We've got these numbers from the newspaper, but maybe you are not spending on products that have that level of inflation. They might have higher inflation, they might have lower inflation. What's happening for you as an individual? Are those rising interest rates impacting you negatively or positively? Because it could be both. And a lot of times people look at rising interest rates and say, oh no, mortgages. But how about, oh yes, GICs, those are cool. And volatile stock markets, those stock markets can be negative in that it's not a great time to sell, but it might be a really great time to buy. And the issue here is the right move for you is the one that works for you as an individual. So know your stuff, pay attention to what you can control, and try to block out the noise of the outside world.
Thanks, Julia. Son?
Look, I'm going to disappoint you and say that a plan is really the most important thing. And the reason is because what Julia just said actually is all designed around having a plan. And what I believe in is retirement is this wonderful period. It's not actually, it's supposed to be a period where you're supposed to enjoy. You just worked your tail off for so long to go and actually finally get some freedom. And freedom comes from security. And income security is the thing you need. And so what I always say is if you have a plan, once you have a core plan, you've designed a good plan, you actually can step back and not be worried about the noise that's happening in the market. In fact, the best thing you can do is ignore all of this stuff, because all of this stuff is irrelevant if you've designed a nice plan. You should go and live a wonderful retirement, and you deserve that. And it starts with structuring the course and the path that you have to go on. And like I said, the one thing you don't know is how long it's going to be, but you should enjoy every minute of it. That's what and the plan helps you get there.
All right. We have 5 minutes for questions. Who's got one? They're just going to bring you a microphone.
Thank you. You talked of planning or retiring things where your portfolio or your investment is just one part of the overall thing. You could go with your shares or your mutual funds and also the guaranteed retirement thing. And you said this could take care of the basic living, so you're not worried about the noise that's out there. What if you flip it around and say you're in a position to take care of your basic living, and what the noise might disturb would be the extra stuff that you want to do, enjoy the retirement, play golf every day, travel around the world, travel first class, business class, blah, blah, blah. Does your kind of system take care of that, or does this only take care of the basics?
No. I think the question, it's a great question, and thanks for the question. What I'm basically saying is that when you get to retirement, you've got a hierarchy of needs that changes. Like, the hierarchy, the first hierarchy of needs is that I need to make sure that I've got my basic income needs, however you're structured. So you've got CPP and OAS as a foundation. You know that with really strong confidence that the government's going to backstop that, and so you're good. And then most people have a gap between their next level and with inflation and things like that, there's growing needs in that. And so making sure that you have that, no matter, come good or bad markets, you can always have that income stream coming in, is a foundational hierarchy of needs. Once you've gotten that, then you can start to plan and design the next phase. Alexandra said something really important. Retirement isn't only about decumulation. You actually may have a choice that you want to have some money left over for the next kid and your kids. You may want to have give away a lump sum at the end of your life to a charity. You may want to grow. Like, there are families that want to grow their wealth, when they pass away. So all these things matter. But no matter what the structure of that plan is, it starts with making sure that I don't eat into my income through income streams and income needs, because I got to pay for my basic income needs. So that's why I do think that the starting point is your foundation of financial security for income security. That's it. Then after that, it's the fun stuff. It's all the things you can dream about with the excess and the value you get above that. But those are what I care, and I think it does in retirement start with that foundation first and foremost.
What about a question from the people watching us virtually?
We have someone asking about advice on how to find an independent financial planner.
So say the question again?
Where to find an independent financial planner.
Where to find it?
All right, yeah.
Well,
I know.
Various sources.
You can go. There are a couple different places you can go. But if you're looking for a certified financial planner or a qualified associate financial planner, those are the two certifications from FP Canada. We maintain a list on our website, which is just fpcanada.ca, and there's a find a planner function. You can screen by location, and I think there's a few other screens that you can add. So that's where I would start.
Yep. I would add that I have a spreadsheet that was produced by a financial blogger, and it has people coast to coast, CFPs and others, who work on a fee-for-service basis. You can have a consultation with them. You can scale it to your needs. You can look at their specialties, and if you email me, I'd be happy to send it to you. I've offered this at many different speaking engagements, and I'm always surprised how many people remember to email me afterwards to get it. I've sent it out dozens of times, and I think it's a big help. rcarrick@globemail.com. I'll start sending them out tomorrow if you email me this afternoon. It's a great resource, and it could probably give you a choice of quite a few people to talk to. We have time for one more quickie question.
Good afternoon. You can hear me?
I'm completely unfamiliar with the concept that you just described. Is there, is it possible for you to give a real life example of using numbers about how this plan works?
Yeah.
And is it similar to an annuity, which I've been told by many people, don't ever buy an annuity because the insurance company takes all your money. So how is this different from an annuity?
Sure. So, sorry to interrupt you. We have 30 seconds left. Now it's down to 23. Maybe you and this gentleman could have a little chat afterwards, because I have a feeling that's not a short answer to that.
No, I just say happy to do it, and you can go to our website. We have a great video that describes it, but retirewithlongevity.com. But I'm happy to take you through it separately.
Okay,
People
great.
need to
Well,
stop
let's
trashing annuities.
Purpose of a booth here?
Yes. Just that card.
All right, let's stop there so we can get on to the next panel. I just want to thank everybody. Thank you, Som, Jason, Alexandra, and Julia in Surrey, BC for joining us today.
Thank you. Thanks, everybody.
Thanks, everyone. Much obliged for coming down. All right, next we have a conversation focused on a subject that I find super interesting, the transfer of wealth. Many parents and grandparents are in a fortunate position to support adult children and also grandchildren with life goals such as home ownership and education. We have two great speakers here today to talk about the different options and considerations. Please welcome to the stage Wilmot George, Vice President of Tax, Retirement and Estate Planning with CI Global Asset Management. Also joining us is Mallory McGrath, founder and CEO of Vive Planning, a company she founded to help families plan collaboratively and navigate common pitfalls. Let's start, Wilmot, talking about some of the tools available to parents to transfer wealth. And of course, we have something new to talk about, the TFFHSA, tax-free first home savings account. First of all, have you discovered a handy catchphrase for it that we can use? Or are you using that horrible acronym?
I'm using the horrible acronym. You know what? We have so many acronyms to deal with now. We've got the FHSA, we've got the RRSP, we've got the TFSA, we've got the RRIF, we've got all these acronyms. And each of these plans have a different purpose.
Let's start with the TFFHSA. I think I'll just shorten it to FHSA, First Home Savings Account. It was announced in the last federal budget. It was launched in the previous election campaign, and it's generated a lot of interest. I know the final legislation spelling out dotting all the I's and crossing the T's has not been released, but what do we know so far about it?
Well, what we know is the government is going to forego $725 million over a 4-year period here to make this highly efficient account available to individuals who want a down payment for a home, right? Ultimately, that's what the purpose of this plan is. And in the budget, this was a centerpiece of the budget. I mean, the government's talking about this, or has been talking about this for some time, going back to their election campaign not long ago. And this plan, as mentioned, is designed to help people accumulate cash flow for the down payment of a first home. And that's a key point, first home, right? So what we know is you're going to be able to make contributions to this plan. And like the RRSP, you'll be able to deduct the contributions to this plan. The investment income within this plan will accumulate on a tax-free basis, assuming that income will be used to purchase your first home. You can withdraw it tax-free. That's the nuts and bolts of it. So you've got a combination between the RRSP type concept and the TFSA type concept with this new first home savings plan.
And how much could a parent gift a child to put into this plan?
Well, you can certainly gift kids money to put into this plan. I think when you think about this plan, we'll talk about the gifting aspect in a minute, but when you think about this plan, you want to think about, the individual who's going to use this plan. there are contribution limits associated with this plan, $40,000 lifetime, $8,000 per year. So if you're going to gift your kids money, you can certainly gift the money to contribute to this plan, but ultimately, as the money grows within this plan, it can be used for a first home. Now, there are some key points to keep in mind with respect to this particular account, and those key points include you must be a first-time homebuyer, right? So in order for you to be eligible for this plan, you have to be age 18 or older. You need to be a Canadian resident, and you must not have owned a home that you lived in the year you opened this account or the previous 4 years. Right? So if you own a home, you're not going to be eligible for this plan, but if you did not own a home in the current year, previous 4-year period, you can be eligible to use this plan, right? And that's a key point.
Okay, now when I wrote about the tax-free first home savings account a while back, I was talking to a financial planner and he said, don't forget about the plain old TFSA. It's great as a way to transfer wealth. Tell us a bit about how a parent might use a TFSA to transfer some wealth to an adult child.
Yeah, now we're talking about a gift, right? So ultimately, if a parent wants to contribute, we'll say, to a TFSA for their child, they're gifting their child money, and that child must use the money to contribute to their own TFSA. There are specific rules in the Income Tax Act that say that I can't contribute directly to my child's TFSA. Only the holder of a TFSA can contribute to their TFSA. So I would be making a gift to my child, which my child would then take and contribute to the plan. So you can certainly do that. So the question is, how can we gift to our kids? There are certainly cash gifts for contributions to TFSAs and RSPs and the like. Perhaps we gift to our kids by way of a trust, formal trust, for example. Right? That's another way to do it. Perhaps you don't want to gift your child money directly. Perhaps your child doesn't manage money appropriately. Perhaps your child has disabilities and can't manage money. Perhaps your child has creditors, in which case a formal trust can be used. Now, a formal trust can be established while you're living. A formal trust can be established at the time of death. But there are certainly some benefits associated with establishing a formal trust while living. But then there's other reasons to establish it at death as well.
Okay, thanks a lot. Mallory, can you give us some perspective for parents on deciding how affordable it is to transfer wealth to adult children? I mean, retirees typically have some active years early on. We've heard a lot about that earlier on when they want to travel and enjoy life. And later on, there are healthcare costs to consider. So there's this debate. I want to give my kids money, but how much could I afford? What thoughts do you have on that?
Mm-hmm. You know, I really loved the way Jackie Porter actually described those 4 stages of retirement, so I'm going to pull from her brilliant idea here. So let's talk about those unknown years, because really those are the years that are hard for us to budget for, right? Those other 2 phases, we can kind of figure it out together. But when it comes to the unknown years, here's a statistic for you. 100% of people that were polled in a recent study said that they wanted to age in place. 100% of baby boomers said they wanted to age in place, that they didn't want to move to a retirement home, to a long-term care home at one point. So given that, we need to think of the costs associated with aging in place. Did someone want to give me a microphone that I can hold in hand there? Sorry, apparently this one isn't working. Sorry about that. No, it's okay. Oh, this one good? Yep. How's this? No? That's okay. There we go. I think we go. Okay, there we go. Everything's okay. Thank you. I'm here all day. All right. So, So aging in place. So Jackie also mentioned the cost of a PSW, right? The idea that on the cheap end, there may be $25 an hour. And if you got a nurse, you're upwards of $100 an hour. So I did a little quick math over at my table there and thought about $50 an hour, 24-hour care all year long. Anyone do that quick math in their head? It petrified me when it came out over $436,000 a year to have someone care for you in your home. So now let's think about gifting money to children to go into real estate. With the average 3-bedroom home being over $1 million, I just bought into the Whitby market. That was insane. We're looking at $200,000 or more to help our children get into the real estate market. And if you're planning on aging in place and needing that money for PSW or nurse care, this might not be the best choice. Sorry to all my millennial friends watching, but this might not be the best choice for your boomer parents.
Thanks, Mel. That's a very refreshing perspective.
Terrifying perspective, I know.
A little different than what we typically hear. Wilmot, what are some of the tax, and I would add emotional advantages and disadvantages of transferring wealth to adult children while you're still alive versus in your estate?
Well, one of the great things about gifting while you're alive is you can see your kids enjoy that money, right? And, you know, I tell my parents that one all the time. Right? You can see them enjoy the money. And I'm not telling you a lie. My dad passed away a couple of years ago. My mom's widowed. And I see her a couple times a week. And my mom loves giving me money. And it's not because I need the money. Right? I have myself, my two brothers, we do, reasonably well financially, but she just enjoys seeing us receive that. She's a giver, and she likes to watch us use that money and benefit from it. So there's the emotional aspect associated with, giving before death, seeing your kids enjoy that money and enjoying what the feeling that you get from that. And again, if you're gifting assets before your death, one of the main things to understand is those assets will bypass your estate in most cases. So now we're getting into some estate planning conversation here, right? Because if assets flow through your estate, and there's a time and a place for assets to flow through your estate, I'm not saying not to give assets by way of death, but when you give assets by way of death, assets that flow through your estate may be subject to estate administration fees. Assets that flow through your estate might become subject to complex estate settlements, might become subject to delays. It can take months or even years to settle an estate. So when assets flow through your estate, there can be some delays before your beneficiaries receive those assets. By giving those assets before death, you avoid those delays. You avoid potential estate administration fees. And you can also speak to and prevent conflict, potential conflict. If you leave that asset to flow through your estate when you die, there could be some potential conflict amongst family and friends after you're gone. If you give the gift before you pass away, you can speak to why you gave that gift and prevent potential conflicts down the road, right? So there are some estate planning benefits associated with giving while you're living. There's some emotional benefits associated with giving while you're living. One of the other benefits associated with that is income splitting. What does income splitting have to do with gifting before I pass away? Well, if you gift assets to your adult kids, then any future income they realize from that gift is taxed to them, not taxed to you. So if you have enough assets while you're living, and that's a key point, we don't want to give away assets that we might need down the road, but if you have sufficient assets while you're living, you're comfortable, you can gift assets before you pass away to your adult kids, and any future income, capital gains, would be taxed to them and not to you. And what that can do is, if you're near those, that OAS clawback threshold, there's a clawback of OAS. Once your net income exceeds a certain amount, the government starts to take back your OAS. I think it's around 82,000 is the threshold, up to 133, in which case you have no OAS. Gifting assets and having future income taxed to your kids can be a benefit. But of course, we also have to think about, if you're gifting assets in kind as opposed to gifting cash, or if you're selling securities to gift assets to kids, understand that you might face some capital gains tax at that point in time. So in effect, by gifting while you're living, you might actually be accelerating your tax bill as opposed to giving at the time of death. So there are pros and cons associated with the gifting conversation.
Wilma, you mentioned something about potential conflicts, and when I talk to estate lawyers, the stories they tell on the conflicts are quite something. Mallory, what can you tell us about the family dynamics that come into play when parents with multiple children offer cash help or gifts? What are the pitfalls?
I'm going to tell you a little story from my time as an estate litigation law clerk. I'm in an estate mediation. There's two siblings on one side of the table and two siblings on our side, and they're just ripping each other apart over not that big of an estate, mind you. And I'm sitting there with my boss, the lawyer, and the mediator's doing his best to just get to the crux of it. Like, why are we battling over not a very large estate? It was maybe a $2 million estate 10 years ago, which is not very big.
And one of our clients stands up, slams her hands down on the table, points at her sister across and says, "Mom gave you the Judy Jetson lunchbox." Everyone's in shock, and I lose it with laughter. My boss is looking at me like, "You shut up right now." I can't stop laughing. I'm like, this is what families are coming to. But the more I broke down that very strange moment, I realized the Judy Jetson lunchbox is love. Money is love. So when you give $200,000 to your second-born child because they didn't buy their house before this insane real estate market happened, then your first-born child's gonna go, "Hi, why? Just because I got into this real estate market before it was hard, why don't I benefit from your hard-earned money, mom and dad? Why does my younger sister get it and not me?" And that isn't necessarily maybe jealousy, but not that the child is selfish. It's really just the idea that we assume that our parents love us equally. They may not like us equally, but they love us equally. Therefore, they should love us with their money equally. Now, it's different if a child needs money to actually survive, right? I mean, that's different. A lot of times we can wrap our heads around that if our parents help a sibling who's actually struggling. But being gifted $200,000 to break into the real estate market, is that struggling? Not necessarily. So this is something that I see a lot with my clients, them coming to me saying, "God, I feel so horrible for my millennial child. I mean, I have this money, so I might as well gift it and help them." And my response a lot of the times is, look, if this is that important to you that you help this one child, then we need to go to the 3 C's here, which is communication, collaboration, and connection. And if we are not communicating with our family, everyone in the family, a lot of times this involves the spouses of your adult children as well, if we are not including them in the conversation about gifting money, then we're setting the family up for jealousy, greed, resentment. This is a destructive cocktail of emotions, people. We don't want them mixed up in a fancy martini glass. It's going to be a bad situation. So you've got to start communicating about your choices and making sure that everyone in the family unit at least respects what's going on. They don't have to like it, but at least understands the emotional reason behind your choice, because there's always an emotional reason behind money.
Mallory, I am curious about how many of the conversations you're having with clients about wealth transfer revolve around real estate these days.
Definitely a lot. I mean, a lot of times real estate, it has to do with helping their children break into the real estate market. A big one is cottages. The gifting of cottages is the most contentious and litigated issue in Ontario. Family cottages bring as much joy as they do destruction to a family. So that's a really big thing to consider when you are planning. And a lot of times cottages, any sort of real estate, it's not just a lawyer that needs to be involved. It's also the idea, do we want to set up trusts, right, to help with the cost of real estate, and also working with an accountant to deal with capital gains. And again, when it comes to gifting money for the purchase of real estate, whether it is a first home or maybe it is a cottage property or whatnot, we need to be conscious of just the repercussions, right? It's that pebble in the water and the ripple effect that comes. We need to think about how this beautiful gift, because it is a beautiful thing that you want to do, but how it's going to be viewed and how it's going to be emotionally felt by everyone in the family unit.
Wilmot, any thoughts for parents who will be joint owners of houses with their adult children?
Wow, that's a big topic. It really is. And many parents consider joint ownership with their adult kids, because of estate planning reasons, right? The thought is that if I list a property jointly with my adult child, and I'm talking joint with right of survivorship here, there's different ways to have property listed jointly, but I'm talking joint with right of survivorship as opposed to joint tenants in common. With joint with right of survivorship, when one joint owner dies, the asset bypasses the estate, goes directly to the surviving joint owner, and it's easy to deal with that asset in a lot of cases, more so than through the will. So this conversation about having property listed jointly is a conversation that many parents consider, but there are risks. And it's not just real estate. In my specific industry, I work for CI Global Asset Management, we see this with investment accounts as well. Parents get a little bit older, They don't move around as well as they used to. Perhaps there's a child that lives close to them, helps them with their day-to-day, and the parent decides to add the child as a joint owner, joint with right of survivorship. We like joint with right of survivorship between spouses. With kids, there are risks, right? And some of the risks include, well, do they have creditors? Are they part of an unstable relationship, right? Who's going to have signing authority for this particular asset? Is it going to be all assigned together, in which case your kids can hold you hostage? Or is it anyone can sign, in which case you show up at the bank one day and your assets are gone because your child, took those assets, right? So there are those risks. But then there's also the potential for conflict when you're gone. And to illustrate this point, I'd like to use an example that we see quite a bit. If you consider a scenario, we have mom, and mom's name is Mary, and mom is widowed, and mom has 2 kids, daughter number 1 and daughter number 2. And daughter number 1 lives close to mom, helps mom with her day-to-day affairs. Daughter number 1 doesn't have a young family. Daughter number 1 doesn't have the job that keeps her away from home quite often. So daughter number 1 has the time and the energy to help mom as mom ages. Daughter number 2 has got a young family, lives much further away, doesn't have the time, although she loves mom just as much, doesn't have the time to be with mom and help mom age. So mom decides, I'm getting a little older, can't get to and from the bank as much as I would like. Perhaps I should add daughter number 1 as a joint owner on my account. Daughter number 1 can go to and fro and access the money for me on my behalf, should I not be able to access it myself. And I might even avoid some probate tax at the time of death. So mom adds daughter number 1 as a joint owner. Now, mom doesn't indicate what she wants done with that account at the time of death. Mom has a will. The will says, on my death, any estate assets are to be divided equally between my kids. But the will doesn't reference that joint account. Shortly thereafter, mom dies. Daughter number 1 goes to the financial institution and says, mom has died, here's a death certificate, I'm the joint owner, please transfer this account to me. And the financial institution does that because it's a joint account, joint with right of survivorship. Shortly thereafter, daughter number 2 contacts daughter number 1 and says, hey, daughter number 1, it was tough to see mom go. We loved her so very much. I know you're settling all the assets in the estate and so on. I know mom had this account, and I know she had you listed jointly on it. I'm just wondering when you're going to pay me my share of that account. Daughter number 1 turns to daughter number 2 and says, excuse me? I spent the time and the energy helping mom as she was aging, back and forth, helping her with her day-to-day affairs. Mom wanted me to have this account to compensate me for my efforts. Daughter 2 says, you're crazy. You know mom loved us equally. You know she would have wanted that account divided between the 2 of us. Look at her will. Her will says any estate assets should be divided equally. Surely she would have wanted this account divided as well. So now we have a problem. Now we have a rift in the family. Now we need to figure out what's going to happen with this account. The moral of the story here is I'm not suggesting you don't use joint ownership as a strategy. Again, we like it between spouses. There are risks associated with kids. In some cases, it can make sense. But if you're going to list property jointly, you want to think about the pros and the cons, the benefits and the disadvantages, and weigh them to determine what makes the most sense, right? So, we see that with investment accounts. We can see that with real estate as well. And we want to try to avoid conflict and confusion. This is the reason why we recommend working with a financial advisor to help with these things, provide you with the information that you might need to help you avoid potential problems down the road.
Mallory, we've been talking about parental help to adult kids. Could you help give a voice to the adult kids? What would the adult kids like to tell their parents about wealth transfer?
Yeah, well, I'm going to turn that question a little bit and maybe give the non-millennial voice, like what kids aren't going to say, but what I'm going to say should be done for millennials. Each generation has had its struggle, whatever that struggle might be, right? The silent generation lived through 2 world wars, something that Canadians who were born in Canada can't possibly understand, right? And then we have the baby boomer generation, the largest generation we've ever had, that had to rebuild society and the economy in a way and create stability and growth, which is such a remarkable thing to have done as a generation. Then you have Gen X, these very individualistic, very forward-thinking generation, and then you've got me, right? You've got the millennials who unfortunately get this bad rap as being entitled, being far too technology-focused, right? Being on our phones at the dinner table and not paying attention to grandma and grandpa when they're talking to us. And so as I look at what each generation has gone through and will have to go through, I think to myself, as someone who primarily does work with baby boomers, I think, do we need to own a home? Do I really need to own a home? What I need for my husband, for my child, is a safe home, not necessarily a home that I own. Home ownership, we talk about owning real estate as it being this remarkable investment in our future, and I don't diminish that in any way. And the financial people here today will talk about, I'm sure, how that is such a great thing to have, but it isn't the only thing to have. There's so much for us to think about when we are raising our children. And even though I'm raising a 6-year-old and all of you are raising people my age, we're still parents and we're still actively raising them in some way or another, right? We don't need to give them the handout. They can live in that apartment with their family a little bit longer if they need to. They don't need to buy a house. All my millennial friends are freaking out right now at home watching this, guys. They are not happy with that response. But $200,000 plus, because let's be honest, it's plus, that's a lot of money to give up when the average age right now is 89 for women and 86 for men. And that's average. Women are getting up there into the 90s easily nowadays. That's a lot of money that will be spent on your care, because quality of life isn't always something that is provided in long-term care homes, as we definitely saw during COVID. Even if you were in a really good long-term care home being provided with care, it's giving you a good quality of life, but not necessarily enjoyment quality of life level. And that requires paying for private PSW or nurse care to come in and give you that enjoyment, having a companion. Your adult children and grandchildren love you, but they have lives and they can't be there every day. So to ensure that you are happy every single day in the remainder of your life, you have got to be thinking about you before your kids sometimes. It's a weird parent thing, right? We put our kids before ourselves, but you know what? In the long run, they are going to be thanking you that you kept all of that money close to home, because when you're going into your 90s and needing that level of care, they're going to be happy that they're not having to dip into their own savings to support you through your long life.
Mm-hmm. Thank you, Mallory, again for that perspective. We have 3.5 minutes left for questions. Who would like to ask something? We have a question right down there.
I have a question. I have a very specific situation. My sisters and I, we are constantly asking our retired parents to spend more money on themselves because they're in that, stay-at-home stage and they're just not investing in the home, making their lives comfortable. So having the conversation with your retired parents, do you have any guidance for the adult children? What expectations, how do I have that conversation? And then what expectations should I have in how I can influence them to use their money on themselves?
Is this for me? For either. Okay, I'll go. Is that all right?
Yeah, please.
So something I say to younger clients that I have, whether it be millennials or Gen X, and they're talking about their older parents, is you need to demonstrate.
planning to them sometimes, right? I think it goes in either direction, right? We demonstrate things to our children so that they'll learn, and sometimes we as children need to demonstrate things to our parents, right? It's like when I'm teaching my mother how to use her iPhone, as an example, right? Sometimes we need to be in different roles within our parent-child relationship. So something I say a lot of times to younger clients is, why are you not doing your planning? Why are you not doing that? Because then you can show up at their house for Sunday dinner and talk about you, not them, you, and what you're doing for your future and your life. It's not putting the pressure on them to do something for themselves, but you yourself. And then that opens the conversation in a slightly easier way. The other thing I say is always, it shouldn't be about how this is going to impact you and your sisters, I believe you said. It's about your parents. It's about their quality of life and you wanting to make sure that they have everything that they want, right? And it is difficult. I mean, we will act this way when we're older. There's only so much that we can do to educate ourselves now, but we will still be in a position when I'm in my 60s and 70s having done this job, my child's still going to be rolling her eyes at the things that I say. You know, I'm still going to fit into that mold, you know, but if we can say to them, like, I want you to have this. I want you to have the life that you deserve to have. And I just want to be able to make sure that we can facilitate that for you, that we can help. And I think a lot of times parents are really scared about being burdens to their children. And they think that by having the conversation, they're inviting that burden to come into the family. But really, the burden is when you're up till all hours of the night figuring out how to apply to be guardian for property for your mom. The burden is them dying all of a sudden and you being like, where's the will? Where's the money? Do they have a financial advisor? Do we have an accountant who we can use? That's a burden. Dealing with things in moments of stress is a burden. Dealing with things when life is good is never a burden. And that's something that we as the children of boomers need to remember, and also something that the boomers themselves need to remember.
And on that point, if I can make a point there too, to the extent possible, just spend time with your parents, right? Just spend time with them. Have conversations with them. You know, to the extent possible. I know this is not always possible, but, you know, spend time with them. Take them out. You know, show them things out there. And I would find that parents would be more inclined to spend money when you take them out, right? So, and spend money on themselves. So, you know, I always think it's, you know, we often think about dollars and cents and we think about the planning around dollars and cents, and we really should. But it's also about, you know, just the emotional side as well. Just spending time with your parents as they age, because they're not going to be there forever. And you know, take them out and you'll find that they'll spend their money and they might spend it on you too.
It looks like there's a question way in the back there. Do we have time?
Unfortunately, we're just about out of time. We're going to have to cut it off. Thank you, Wilmot, and thank you, Mallory, for joining us today.
Thank you.
Thank you so much.
Thank you. Good to be here.
This concludes our program. We've recorded today's event, and it will be sending around a link to those who registered in case you would like to view it again or to share it. On behalf of the Globe Mail, I would like to thank Purpose Investments for their support of today's event. I would also like to say thank you to everyone in the audience, both here in the room and virtual, for joining us today. And now I'd like to invite those in the room to stay and enjoy a drink and some networking just outside the main hall. Thank you again, everyone.